we welcome our colleagues from SMR Consulting, who've got offices in both Istanbul and in London, I believe, or close to.
Marlow, close to London. Yeah.
Marlow, close to, yeah, in the UK. So we've got experts from both ends of the pipeline. And we also have Mehmet Basharan, who's a senior advisor at the Inward Investment Team in the Consulate, part of DIT. His speciality is technology, so we'll be waiting to hear what he's got to say about e-commerce and online sales, which we've all been benefiting from during COVID, and I'm sure this is going to be something that continues. So it's going to be an interesting discussion on how VAT in UK and for online and distance sales how that will have an effect post-Brexit. So I think our colleagues on the webinar today are keen to understand just what implications in relation to VAT that they'll have to deal with in the post-Brexit era. I mean, fortunately, we have signed our free trade agreement with Turkey on the 29th of December. That puts us in a strong position. It's a continuity agreement. Therefore, we've rolled over the current, the trade relationship that we had with Turkey before we left the EU. So, business continues pretty much as usual in that respect. And we also have an agreement in the FTA that within the next 2 years, the two governments will be negotiating an enhanced free trade agreement to strengthen that relationship and bring in new areas of opportunity for both UK and Turkey. So we're in a good place. We are moving forward, and our trade relationship with Turkey is vitally important to UK and vice versa. So I'm going to leave it to the experts, Anil and Tim, to share their knowledge and advice and give us guidance on what they need to be aware of in relation to VAT. So we'll get it from the UK perspective. We'll also get it from the Turkish perspective. So I'm going to hand over to Mehmet, who will give us the government's perspective on the post-Brexit environment, and hopefully he'll talk a little bit about the new free trade agreement that we have. So Mehmet Bey, please.
Thank you. Thank you, Chris. Thank you for the introduction as well, and please thank your team for organizing this webinar today. It's great to be here and collaborating with you once again. So let me share my screen first, and we can easily start afterwards. Okay, I believe you can all see my screen now. So I believe most of you have already known me. So just as a brief introduction, my name is Mehmet Basharan. I am working as a senior investment advisor for the Department for International Trade for the last 7 years. And according to some rumors, I assisted like almost 500, 600 companies investing in the UK up to now. So, but I would like to warn you, as Chris said, main specialty, my main focus is technology sector, and e-commerce is, let's say, is considered as both technology and both retail. So my information on that field may be a little bit limited, just as a brief warning beforehand. Let me give you a brief introduction about the Department for International Trade. Don't worry, I'm not going to read all of those in the slides, so you can read it all now. But the Department for International Trade is the official UK government body which supports foreign companies in setting up, investing, or expanding in the United Kingdom, or the UK-based companies seeking to trade international, seeking to export to the international markets. We are, in means of the inward investment side, we offer free and confidential support to the companies, including, let's say, fully integrated advisory service, latest business intelligence, information about market data, market regulations, stakeholders in the market. By stakeholders, I don't want to mean that we are providing you some client information. I mean, let's say associations, let's say multipliers, etc., etc. So we also work with, we are not only working alone as the department, we are also working with some, let's say, partners in the field, such as the local and international stakeholders, let's say devolved administrations, city councils, etc., etc. In short, what we are trying to do is we are trying to, let's say, ease your path to the international markets by providing almost every data, every information that you need in going global. So, okay, let me start with giving information about the sector itself. As I said, the e-commerce sector is considered, let's say, in the middle. So it has components from the technology sector itself, it has components from the retail sector itself, but mainly it is actually a retail sector. So let me start by the technology sector. So in means of technology sector, the technology sector in the UK is growing very, very rapidly in the UK. It's one of the, let's say, hot topics for the UK government, for the UK economy. You can easily see that it's growing almost 3 times faster than the rest of the UK economy, and which is, let's say, in the digital technology sector has an annual turnover around 180 billion pounds at the moment. So the sector, the country itself actually is offering significant opportunities for the inward investment clients in the sector. So what do I mean by this is actually when you look at the technology sector itself, you can see that we can divide the technology sector into 3 main segments. The services segments, segment is, let's say, includes subsectors like fintech, software development, cybersecurity, which actually cybersecurity is, let's say, becoming another hot topic because of the COVID-19 issue, and which is directly linked with the e-commerce field. Manufacturing and industry, 5G, industry 4.0, robotics, automation is another, let's say, segment. And the consumer side, so we put e-commerce here, but also we put, let's say, we include connected devices, smart homes, let's say smart mobility, etc. as well. You can see, let's say, I try to, let's say, compile some small data, some information about the sectors itself, but I will be talking more about the let's say, e-commerce in the next slide. So when you look at the e-commerce sector, let's say, as I said, we also be speaking about retail sector itself as well. So the UK is the most international retail market in the Europe. It has, let's say, more than 300,000 local and international companies. It has a, let's say, very vivid, very, let's say, how can I say it, behavior. So the leading there are a lot of, let's say, innovative startups in that field as well. So we are talking about the largest e-commerce market in the Europe, which is actually representing almost 30% of the whole EU market itself. And what we are talking is, as you know, UK has a population of 66 million at the moment, and we are talking about a consumer base which is highly, let's say, highly responsive to the new technologies, and which is using e-commerce and m-commerce, mobile commerce as well, very, very rapidly. So as I said, UK is one of the largest and the most innovative retail markets in the Europe, and according to some statistics which was actually compiled by the UN, UK is ranking 5th in means of e-commerce preparedness, and what we can say is, for example, there should be a, let's say, statistics around here. It says right now, oh, sorry, I cannot see it here at the moment, but yeah, okay. Right now, UK has a, let's say, in 2021, the government is expecting the UK e-commerce sector to grow up to be around, let's say, 200 billion pounds worth of, let's say, let's say value. So what we can say is e-commerce, for example, is literally has a bigger potential than the technology sector itself, for example. So you can see some, let's say, comparisons here. I don't want to, let's say, spend too much in comparing UK with France or Germany, etc. But you can easily see how advanced the UK is on those fronts, especially if you look at the, let's say, graphic on the right hand side. UK is literally moved ahead on this, and we are talking about the data which is coming from 2017 and 2018. With the COVID-19 issue, the market actually grew literally, how can I say, incrementally. Okay, when, let's say, when companies comes to us, for example, in means of, let's say, getting advice for investment operations, we experience that most of the companies are literally planning to go to London. But the first question that we ask them is London the best location for you? Because there are other places which may be more suitable for your field of work. And when you look at the e-retail or e-commerce market, so to speak, there are several key clusters all over the UK. For example, when you look at the northwest area, which is, let's say, the orange, let's say, appealed on the top, you can see that it is, let's say, it's one of the key manufacturing hubs with the third largest UK clothing and footwear manufacturers, and, let's say, very nice, let's say, UK consumer electronics manufacturers. London is the center of everything nearly, but when you look at the southeast, for example, you can see that it literally offers good, let's say, potentials or good opportunities for the companies with cheaper rents, let's say, ideal locations, let's say, better living, so to speak. So when you are, let's say, we always tell people, that companies, that when you are investing in the UK, you should be, let's say, considering not only London, but the overall UK as well. There may be some clusters for you in the field of e-commerce. By saying so, I'm not going to talk about this. It's very basic, but in the end, we are moving, let's say, I'm trying to move towards why companies should be investing in the UK. But before doing that, I would like to tell you about actually how the dynamics in the market are actually going on. So when, let's say, when you talk about, let's say, the entrepreneurship ecosystem, you always talk about the market data, social capital, advanced infrastructure, and financial capital together. So you need to consider every ingredient in their own form. And when you look at the UK, you can see that UK is based in the, let's say, most bluish area in that graph, because in means of social capital, there are incredible amount of networking opportunities, tech meetups, etc. in the UK. The market, as I informed you very briefly, the market is growing very rapidly in the UK. The financial capital sector, venture capital ecosystem is actually growing very rapidly. For example, there is a data here, but I would like to correct this. For example, in 2019, the venture capitals actually invested almost 15 billion pounds to the UK startups. Not only tech, it can be e-commerce, it can be fintech as well. So and UK is literally has the most, let's say, unicorns in the overall Europe, so to speak. And in means of advanced infrastructure, I'm going to talk about this in a later stage, but UK is literally offering, let's say, digitalizing options for some cities, for example, the, let's say, most connected cities, etc., digital connected cities, etc., to the, let's say, companies. Okay, so there it is. So I have already talked about this, so I'm moving those and why, and we'll start talking about why companies should be investing in the UK. Please let me know, by the way, I'm trying to rush a little bit, let's say go quick, because I don't want to steal, let's say, Anil's and Tim's thunder on this one. So I'm, let's say, rushing a little bit. But if you tell me that slow down, I will slow down. If you go wrap up, I'm going to wrap up. So why companies should be investing in the UK? So there, in basics, we can tell that there are actually 6 main reasons. The first one is established, very well established and business friendly environment in the UK. The second one is international competitive tax offer. The third one is a very, let's say, sophisticated R&D and innovation landscape. Talent, skills in the UK. Fifth one, a very strong digital and physical infrastructure. And 6th one is the locations. So I'm going to talk about very briefly on this. As I said, UK is very well established, is providing very well established and business friendly environment to companies which are planning to invest there. So as you all know, UK is the world's largest 6th economy, and according to the ease of doing business rating by the World Bank, UK is ranked as the 8th at the moment. That, let's say, ranking is decided according to, let's say, factors such as setting procedures related to setting up a company, paying taxes, getting electricity, let's say, doing business, opening a bank account, etc., etc. And with all this, UK, let's say, is right now is the best location in the Europe in means of FDI, and there are, let's say, incredible amount of companies which are, let's say, setting up one way or another an operation in the UK. So in the second side, I talked about the tax offer. I'm not an expert. Tim and Anil are the experts, but as a very brief information, I can easily tell you that currently UK's corporate tax rate is around 19%, and it has the lowest corporation tax within the G20 at the moment. R&D and innovation landscape. Okay, this is a very interesting subject, because when we are talking about e-commerce, everyone is saying that there are, let's say, very limited. People are saying that there are very limited, let's say, options in use of R&D, but I am aware that a lot of companies are actually adapting their e-commerce solutions with AI now, so I'm moving ahead. So in means of the Global Innovation Index, for example, UK is ranked as the 4th, and UK actually structures some, let's say, ecosystem or dynamics or stakeholders within the market to actually turn the ideas into commercial businesses or commercial successes. So those, let's say, stakeholders or mechanisms that we can talk about are, let's say, includes Innovate UK grants, innovation loans, R&D tax credit, patent box, etc., etc. I would like to explain more about this, especially the R&D tax credit and the patent box. So, guys, please correct me if I'm wrong on this one. R&D tax credit is, let's say, is some kind of a government incentive, a tax benefit, which is offered to the companies which are doing some R&D in the UK. So let's say that, okay, you can see some graph there. Let's say you need to choose where you are. But if you are an SME, for example, you can apply for the SME R&D relief. And if you are making some profits, then this means that for every £100 that you spend on R&D, you can claim £25 back from the government in means of tax relief. And if you are not making any profits, and if you are just, let's say, losing money, so to speak, then that ratio, that 25%, goes up to 33%. And if you are a large company, if you are a scaled company, then this means that you can only claim 10.5% from the government for every, let's say, £100 that you spend on R&D. there is, for large companies, there is no distinction between profit making or loss making. There is one strict rule. And let's say you did your R&D, and afterwards you, let's say, get a patent from that. So you can apply for a patent box after that, for that patent, which means that you, for every, let's say, for the income that you generated from exploiting that patent, you will be paying the corporate tax at 10%, not 19%. And as I told you, there are some other options such as Innovate UK funding options and innovation loans, etc. So Innovate UK is the, let's say, UK's official R&D and, let's say, innovation body, so to speak. And it has, let's say, four main areas, four main support mechanisms. One of them is the Industrial Challenge Fund. The other one is Smart Grants. The third one is catalysts such as catapult centers, etc. And the fourth one is the research business, small business research initiative. So through those four mechanisms, Innovate UK is actually providing some funding to the companies which are, let's say, which has some innovative ideas, which are, let's say, moving ahead, etc. And since 2007, the Innovate UK has invested almost 2.5 billion pounds to the companies, and which is worth around, let's say, 4.3 billion at the moment. I mentioned that, for example, in the previous slide, I mentioned that Innovate UK is one of the Innovate UK's mechanisms as the Industrial Challenge Fund. So what is the Industrial Challenge Fund? Industrial Strategy Challenge Fund is. So industrial strategy is the main, let's say, priority area of the UK government. And it has, let's say, four main areas, so to speak. AI and big data, future of mobility, aging society, and clean growth. So, for example, if you are operating in those fields, and for example, if you are adapting or integrating your e-commerce solution with AI and big data, and this means that you can apply for any, or you can apply for the relevant, let's say, grants or, let's say, project calls of the Innovate UK. For example, there are some, at the moment, there are 23 challenges, sub-challenges for now, which is, let's say, which is allowing companies to access some funding. And those 6 are some of those, let's say, some of the examples. I mentioned that UK's skill work and talent skill base is very strong. In the end, UK is the, let's say, UK hosts the top 4 of the top 10 universities in the world, and UK's skilled workforce is, let's say, literally is considered as one of the world's best at the moment. And for example, in this video, in this webinar, I didn't include any information regarding the visas, but I can easily tell that UK's whole immigration policy is actually still designed to attract the best skills from the world. So the UK is still forcing ahead and let's say trying to be better in means of getting a very niche, very talented skilled workforce. But I would like to mention a little bit about the labor costs, because this is a question that comes to us almost every meeting. So I believe most of our let's say viewers are coming from Turkey, and I can easily tell you that UK's, let's say, labor law is labor regulations are very different from Turkey at some point. For example, there are, let's say, in Turkey we have only one wage, minimum wage, for example. But in the UK, we have minimum living wage, and there's national minimum wage as well. So you can see some very brief information about that. And for example, if you are employing a staff before the age, which is who is smaller than age of 23, then this means that you need to pay a minimum wage, national minimum wage, which differs according to the age of that person. But if you are employing someone who is, let's say, older than 23, then this means that you need to pay, you will be paying national living wage, which is around 8.91 pounds per hour at the moment. When you look at, I also included a graph, a comparison graph there, and I tried to put, let's say, a very basic data. Very basic data about the, let's say, average salaries, and I took manufacturing sector as an example. So when you look at the blue, let's say, columns, you can see the average salary, annual salary, average hourly salaries, our labor costs in the manufacturing sector. But the red one are the average of, let's say, of the old industries. Moving to the fifth option, why companies should be investing in the UK side. The UK is offering very, let's say, strong physical and digital infrastructure for the companies. For example, UK government has announced that they're investing extensively on, let's say, super broadband to some of the cities in the UK, and they designated 29 of those cities, which you can see from that map over there, as super connected cities, where extra fast broadband and reliable broadband is available to the companies or people living there. So we can easily say that those locations will becoming hotspots actually for the new e-commerce companies globally. For example, I can easily see Cambridge over here, and Cambridge is the, let's say, one of the bases of Amazon at the moment. So that's the reason why Amazon actually located there, one of their premises, one of their, let's say, offices there.
Mehmet,
yeah,
have you got many more slides?
I am, let's say, let me check. I'm almost finished. I can wrap up very, very quickly.
Okay, because we've got a question for you here, which we'd like to ask you.
Okay, let me wrap this up, and I can easily answer it if it's okay. Okay. So in means of location, I actually mentioned about locations, but London, Cardiff, Belfast, Edinburgh, you can invest. When we are talking about the UK, then we are talking about the overall UK South, which includes England, Wales, Scotland, and Northern Ireland. So this is very basic information. Okay, how we are working with the IT. So this is, as I mentioned, this is actually a summary of what I told in the beginning. So we offer free and confidential services to the companies which are planning to invest in the United Kingdom. So if you are, what you can ask from us is information about the market, where to invest, a city comparison, a country comparison, links with stakeholders, some associations, centers of excellences, information about regulations, tax, visas, etc., and recruitment process, introduction with service providers such as SRM here, and it's all free and confidential. I thank you for your time and attention. I hope I didn't bore you, so please feel free to contact me afterwards as well. So Chris, this is my whole presentation, so I can easily, let's say, answer any question that comes.
Yeah, thanks, Mehmet. Very comprehensive and, as usual, very informative. No, you didn't bore us at all. I mean, it's I think it's important for people to understand what the opportunity is in UK. From all aspects, and that will help them make their decisions going forward if they're looking at UK as an investment opportunity. So, very valuable information. There's one question here that I'd just like to deal with, and it's besides corporation tax. If the business is small and not a company, only an individual, what are the advantages, if any?
So being a sole trader, so to speak, it means actually this is beyond our remit, because as the Department for International Trade, we only cover, let's say, we only try to cover institutional investments, and let's say a company investing in the UK and setting up a company in the UK as well, which is limited company or PLC, etc. But I believe Tim and Anil can, let's say, answer this in a better way. But as far as I'm aware, there is no difference between, let's say, being a sole trader in the UK or, let's say, a limited company in the UK in means of accountancy or liability. But it means if we are talking about reputation and getting benefits from the government, there is only one thing. You need to be a limited or the PLC company in the UK. You cannot apply for, let's say, Innovate UK's grant if you are, let's say, if you are a sole trader. It's a very, let's say, it's the lowest reputation of the, let's say, type of companies in the UK.
Thanks, Mehmet. Now, any requests for the presentation that Mehmet has just given you?
Not this one, but I will make it available in a, let's say, a very summarized version of this in the future.
Okay, which the people on the webinar, if you apply to our office at BCCT, I think we've given you the email connection there. Then we can contact Mehmet and he can provide that information. I think it's worth just mentioning that SRM Consulting, we're talking about VAT today, but they have a broader consultancy as well in relation to other tax issues and what's going on, right? Ooh, dear me, that was quick. So I'm sure they may be able to enlighten you on broader issues relating to tax in the UK if that's what you're looking for. Anyway, we're moving on to Anil Bey, and I'm going to leave him to share his advice and guidance when it comes to VAT. And I think we'll be talking about Turkey to UK here. Thank you.
Yes. Thank you, Chris, for passing through. Thank you to the BCCT team, by the way, organizing this such beautiful event today. My name is Anıl Sürmeli. I'm certified public accountant back in Turkey for more than 20 years, and I am an MAAT in the UK as well. I'm partner and the UK director of SRM Business Consulting Limited company. We have our headquarters office back in Turkey, World Trade Center buildings in Istanbul. And we opened our UK office about 5 years ago, and we are trying to provide all our services in the UK as well. Today's topic will be about VAT. As you may all know, VAT is one of the most complicated tax topics out of all other taxes, because the goods and services going through all over the world are subject to VAT, also in national interior as well. And all countries have their own implementations regarding to this VAT. They all have their different rates and different approach for the transactions occurred in their country regarding to VAT. So today we will be going through to the UK VAT system. I will try to share you some information comparing with the Turkish VAT system as well. So I believe it will help you to have an idea easier by doing that. So our presentation will consist of 2 parts. In the first part, I'll give you a brief information about the VAT in the UK. I will talk about some key schemes and thresholds in the UK that you can benefit. You probably heard a lot about making tax digital. I will just try to tell you what it is in the UK. And of course, during all the presentation, I will try to compare with the Turkish VAT system by giving some examples. And in the second part, our main topic is VAT on online and distance sales, e-commerce sales. I will pass through to Tim in that topic when we come to that point. So let me start with VAT in UK. In the UK, when you establish your business, you are not directly responsible for VAT. You have to be registering for VAT. In Turkey, as you know, the day you establish your company, you start to submit your VAT returns in monthly basis, and you have some responsibilities regarding to that. But in the UK, this is not the way it is. So if your turnover is less than £85,000, you are free to register for VAT. You don't have to register for VAT until then. But you can still register for VAT voluntarily if you are still below the threshold, which I sometimes recommend for the companies to voluntarily register for VAT. It depends on your expenses, purchases with the VAT actually, because if you have some expenses or purchases in the UK that you pay VAT to your suppliers, you would like to claim those VATs from HMRC. And at this point, it would be a good idea to register for VAT, I guess. But if your turnover exceeds £85,000, then you must register for VAT. You can choose the suitable VAT schemes and periods once you register for VAT. I will be talking about in the next slide. By, of course, registering for VAT, you will have some responsibilities starting with that. Okay. Now, key benefits of registering for VAT as a volunteer is, first, as I mentioned, I mean, if you have expenses or purchases in the UK, it's good to register for VAT so that you can claim those VATs back from HMRC. And of course, it gives the idea of an established business and prestige. So if you receive an invoice from a company and if it is not registered for VAT, it means that we all have an idea about the turnover of this company, probably. Now, in case of the rates in the UK, the standard rate applies 20% in the UK. In Turkey, the standard rate is 18%, as you know. And in UK, the reduced rate is 5%, and there's also 0% applies. Most of the goods and services are subject to standard rate, which is 20%. Some of the goods and services like children's car seats, fuel, power are 5% at the moment. And some, for example, all exports goods or services are 0 rated, and most food and children clothes are also 0 rated. There's also exempt VAT, which is you don't have to put VAT on those services like betting and gaming, etc. Those are exempt VAT. And there are also some services that are outside the scope of VAT, like postal services or tolls for bridges and roads that we pay. Back in Turkey, as you know, 18% is the standard rate, and there's a reduced rate of 8%, and there's also 1% for some services and products. In the UK, normally, when you register for VAT, you submit your VAT returns in quarterly basis. In Turkey, we submit the VAT returns in monthly basis, but in UK, you have the option to submit your VAT returns in quarterly basis. You can choose your own periods depending on your business periods. But all VAT returns must be submitted in 1 month and 7 days after end of the period. So if we talk about the first period, January to March, you have to submit your VAT return latest 7th of May. In terms of VAT tax, as you all know, there is outgoing VAT and incoming VAT. Outgoing VAT is the VAT on your sales that you calculate your VAT. And the VAT, incoming VAT, is the VAT on your purchases and expenses. If your outgoing VAT amount is higher than your incoming VAT, of course, we talk about a tax to pay to HMRC, like we do it back in Turkey. And this has to be paid to the tax office. But if your incoming VAT amount is higher than your outgoing VAT in that specific period, then you can reclaim this VAT back from HMRC. I think this is one of the main differences with the Turkish VAT system, because in Turkey, those VATs are not reclaimable from the tax office. So most of the times, they stay in the balance sheets as deferral VAT, and by time, they become really a high cost for companies, because those are the VAT amounts that you already paid to the suppliers, and you deserve them to claim back. But in Turkey, at the moment, you are not able to do that. But in the UK, if this is the case, HMRC pays you back those VAT amounts in approximately 7 days' time. As far as I know, 3 or 4 years ago in Turkey, there was a new implementation came to the parliament proposal to make it same exactly with the UK system. So they were planning to pay back all those deferral VATs to the companies, but for sure, this is a huge budget. I mean, many companies have a lot of receivables from the government, and unfortunately, it didn't happen. Another key difference between the Turkish VAT system and the UK VAT system, there are some schemes in the UK which you can apply for. Standard VAT scheme, annual accounting scheme, flat rate scheme, and cash accounting scheme is the schemes that you can benefit depending on your business needs, actually. Standard VAT scheme is the one that I just mentioned, which is the most common and applied scheme. And if you choose to go with the standard VAT scheme, you submit your VAT returns every 3 months. You can choose which 3 months you want to submit. This depends to you. As I said, there is no deferred VAT. So if your incoming VAT is higher than your outgoing VAT, HMRC will pay you back this amount, usually in 7 days' time. Now, annual accounting scheme, there's a criteria, of course, to join this scheme. Your VAT taxable turnover must be £1.35 million or less. If you're over this amount, you cannot apply annual accounting scheme for your company. This scheme is, as you can understand from its name, it's annual based scheme. So you only submit once VAT return a year. You don't need to submit every quarterly. But during the year, you still need to make VAT advance payments to HMRC. And of course, if you don't prepare a VAT return, how do you make payments in advance? This is estimation based. So you need to make an estimation. If you have previous year's figures, amounts, then you can use those amounts to make an estimation and calculation. If you don't, you can just forecast your turnover for the upcoming year, and by installments, as 10 installments or divided to 4 installments, you can start paying VAT in advance to HMRC without submitting any VAT return during the year. And at the end of the year, you prepare your VAT return, and if you still have a gap between what you have to pay, then you pay the balance to HMRC. Which companies can, this annual scheme is good for the companies who wants to manage their cash flow, because at the beginning of the year, you can make an estimation you can fix your amounts to pay to VAT for whole year, and you can easily put this amount into your budget to follow an easier cash flow during the year. And this will avoid you preparing quarterly based VAT returns as well. And if your turnover is increasing regularly during the year, I think it does make sense to apply annual accounting scheme, because the balance will be paid at the end of the year to the HMRC. This is not good for the companies if you have to claim back VAT, because then no need to pay in advance tax, where you will have chance to reclaim VAT from HMRC. And also, if your turnover decreases during the year, then you probably will be paying more in advance to HMRC. Another scheme that you can select is flat rate scheme. This is more suitable for small companies, actually, have turnover £150,000 or less. This is more used for the contractors, IT contractors, service provider companies. The reason is, let me first tell you what flat rate scheme is. As you know, the standard rate is 20% in the UK. But if you apply flat rate scheme, you have the opportunity to choose a reduced rate. HMRC has a list for all sectors. For example, IT consulting service company will apply 14.5% flat rate VAT. So this means that you will still issue your invoices with 20% VAT to your customers, and you will be collecting that amount from your customers, but you will be paying to HMRC with the calculation of 14.5% to HMRC office. In this scheme, there is no incoming VAT. So for your expenses, for your purchases, you will not include to your VAT calculation. Let me give you an example. I think it will make it more clear. You provide IT consultancy services and you decided to register for flat rate scheme. The fixed VAT rate is 14.5 for your services. And in the quarter, let's say you have 30,000 plus VAT sales. You will receive 36,000 pounds from your customers with the 20% VAT rate. Then you will calculate the flat rate according to your sales, which makes 4,350 pounds that has to be paid to the tax office. And you will have chance to keep the balance, which is 1,650 pounds in your company. So this flat rate scheme is good for companies if you don't have a lot of expenses and purchases where you pay VAT to your suppliers. This is good for those sort of companies, I guess. And this is, as I said, popular amongst contractors and freelancers with low VATable expenses. And of course, you can benefit the difference between what you collect and what you pay to HMRC. But if you have high expenses and purchases that you can claim, then this is not for you, because you will be probably paying less tax if you proceed with the standard rate scheme. And of course, as I said, this is more for the smaller companies to apply. And another scheme, cash accounting scheme. This is, I think most Turkish companies would like to see the scheme back in Turkey. Cash accounting scheme is based on your collections and what you pay to the suppliers. So it's not accrual based. VAT occurs when you get your payments from your customers or when you pay to your suppliers. There's a criteria to join this scheme, which is 1.35 million or less. Your turnover must be 1.35 million or less. And of course, you have to be up to date with your VAT returns. So all your previous VAT returns must be submitted on time, and you had no VAT offense to benefit this scheme. By the way, just additional note, you cannot use this scheme with flat rate scheme together. So you pay VAT on your sales when your customers pay you, and you can reclaim VAT on your purchases when you have paid your suppliers. So this is good for companies who cannot collect their payments really on time. If you are getting your payments delayed, this can be good for you. And for businesses who have higher amount of purchases paid, this is not good for you because you already paid to your suppliers, and you can't benefit that at that point. So this is cash accounting scheme that might work for you. Now, once you get registered for VAT, it doesn't matter if you registered as volunteer or as a compulsory, you have some obligations that you have to follow for. For example, one of them is making tax digital. This was introduced in April 2019, and it is now on progress. There was a delay for 1 year because of this coronavirus, but now it is on progress. And all VAT registered businesses with taxable turnover above the VAT registration threshold has to keep records in digital form, and they have to file their VAT returns using a relevant software, which is integrated directly with HMRC. Back in Turkey, we have an implementation called E-Defter, which is also, new, not very old. This is similar to that implementation. So if you are a VAT registered company in UK, and if your sales are exceeding £85,000, you have to be following these rules. So you need to keep your records in digitally and submit your VAT returns with the relevant software to HMRC. Now, I think this is the information I'll be sharing with you today as a general overlook to VAT. And as you are all aware, there are few differences with the Turkish VAT system. And I think the most important one is the deferral VAT situation. So in UK, this is not a cost for companies. And HMRC pays you back all your deferral VATs on time. But in Turkey, this is really a high cost on the companies. And also those schemes that you can benefit are key difference for the UK VAT system when you compare to the Turkish VAT system. Okay, now we will enter to our main topic, which is VAT on online and distance sales. I will pass it to Tim, but before that, I would like to remind you that how it was just before Brexit, how companies were handling this VAT on e-commerce before Brexit. Then I will pass it to Tim to go for details. As you all know, 31st of December 2020, UK is no longer part of EU. And after that date, there are some borders and customs started to apply. But before then, all goods shipped from UK to EU were customs free. There were no borders, no customs, and it was much easier to make e-commerce between UK and EU countries. After 31st of December, there are some new rules started to apply, but they are not really settled down yet. They are still trying to improve those implementations, because the companies who are currently doing e-commerce in these countries are facing a bit problems in the customs or bureaucracy or procedures. But hopefully with 1st of July, there will be some easing procedures coming for European countries. In this topic, when we say online and distance sales, we mention about the companies doing online sales to individuals, not business to business. Maybe Tim will go through those business to business as well if he has time. But the main topic is the companies selling to individuals. Now, how was it before 31st of December, before Brexit? As I said, there were no customs or borders. And UK company, if you get an order, online order from a German individual, you were free to ship your product from UK to Germany with UK VAT on your invoice. But of course, in EU, all European countries have their own thresholds that they apply for VAT purposes. I call this destination VAT. So all those EU countries have declared their own thresholds for destination VAT. So let's say you're a UK company doing e-commerce and you are selling your products to EU. I'm talking about before Brexit, by the way. If you have orders, if you sold your products to Germany, let's say the amount is over 100,000 euros in total, then you have to register for German VAT in the Germany and start giving VAT submissions in Germany as well. At that point, you stop implementing UK VAT because you are over the threshold. Then you start implementing the German VAT because you are over the German VAT threshold. Of course, if you sell from UK to different 10 countries in the EU, this means that you have, and if you are over those thresholds, it means that you have to register for VAT in all those European countries separately and submit a VAT return in their home country. This was how it used to be before Brexit. But after Brexit, of course, borders started to apply and all sales started to be accepted as export. At that point, I would like to leave it to Tim and he will share us more detailed information, I hope.
Thank you, Neil. If you come out, I'll share my screen. Good afternoon, everybody. I'll just introduce myself briefly first. I'm Tim Boss. I've worked with Neil for about 2 or 3 years now. Unlike Neil, I'm a complete VAT expert. It's all I do, nothing else. And I've been involved in VAT for many years, most all my career, in fact, firstly with the revenue, customs and excise in my day, then 2 firms of accountants as VAT director, and latterly been a VAT trainer and consultant. As I say, I've worked with Neil for about 2 or 3 years now. So on the 1st of January 2021, Brexit applied. So how does it affect online distance sales? There is a lot of misinformation around. It is very, very new. People come up with different ideas, different stories. It hasn't helped because the UK, having left the EU from the 1st of January 2021, did a complete overhaul of their distance selling requirements, brought in new rules from the 1st of January for goods coming in to the UK from outside the UK. The EU are doing something similar, and one-stop shop it says there, which I will explain what all that means in a minute. But the EU's rules will not apply until the 1st of July 2021. So there's a bit of a hybrid now. I mean, it's rapidly getting there. It's now the end of May, but that's caused a few issues. So at the moment, I'll talk first about goods going out from the UK. And all sales from the UK to EU countries and non-EU countries will be exports. Obviously, to non-EU countries, they've always been exports. Now there'll be exports to EU countries as well. I have been since the 1st of January, and zero rated in the UK. So the UK companies do not charge UK VAT. An import VAT will be payable in the country of destination. That import VAT will be payable either by the customer or by the person, the supplier, having to register for VAT in those countries, then apply the local VAT rate, having claimed back the VAT they've been charged on importation. And all a bit more difficult than the old days where, before Brexit, where, as Neil said, everything could move VAT-free, there were no borders. There is a limit which still applies until the 1st of July of 22 euros. Under that, no VAT is payable. It's called low value consignment relief, which we have in the UK as well, or did have in the UK as well. So the UK, the EU follow their acronyms. So we've got quite a few now, and different schemes are involved. The EU e-commerce rules will not apply, as I say, until the 1st of July, but obviously it's got to get ready now because that's rapidly approaching. So what has happened? Well, in 2015, we had a system called MOS, the Mini One-Stop Shop, which was introduced for digital services. So under MOS, digital services provided business to consumer, private individuals. Place of supply was where the individuals belonged. So businesses could register in one member state, their own member state. The UK was a member state then, in their own member state, and just also register for this MOS system, which meant they didn't have to register in every single member state. They just did one MOS return and reported the revenues from each member state in which they had customers. So that's still around, but it's been extended now. But the EU Commission, I think, were flush with success there. It did become a very popular way of doing things. It eased the burdens, the revenue increased, and so they were always going to extend it when they could, and have been talking about it for a few years now prior to Brexit. And of course, the UK, being a member in those days, was privy to those discussions. So they extended MOS. We've now got, or will have, 3 separate schemes really. One called the Union OSS, the Union One-Stop Shop, the Non-Union One-Stop Shop, and the Import One-Stop Shop, which is a brand new one. Just very briefly before I carry on, the Union One-Stop Shop can be used by businesses which are established in the EU, in any EU member state, when they're supplying goods and services across those member states, business to consumer. They register in their own country, they have a domestic VAT, they can also register for the Union OSS and report the revenues on this single VAT return, OSS return, as well as their domestic VAT return for sales in their own countries. The non-union OSS is used, or will be used, for non-established businesses, non-established EU businesses, so including the UK, who supply services, business to consumer. So it's extended the MOS from digital services to almost all services supplied business to consumer, and that will kick in from the 1st of July 2021. Union OSS can also be used by businesses not established in the EU in one circumstance, and that is where that business not established in the EU, so for example, as we're talking about UK, we'll talk about the UK, so established in the UK, but keeps a stock of goods in another EU country, so a stock of goods in Germany. And then from German stock, the stock in Germany supplies to other countries around the EU. That business can register for the Union OSS and then just do the one OSS VAT return for all the goods they supply throughout the EU. So OSS can be used by non-established businesses. The import OSS is the one I'm majoring on today, really. The import OSS, or IOSS, is the new scheme whereby you can report all your revenues from goods coming from the UK into the EU on one single IOSS return. And I'll say more about that in a few minutes. And then after that, I'll look at the UK e-commerce rules from the 1st of January 2021, which obviously provide different rules now for goods coming in to the UK from the EU, or outside the UK, to be honest. Right, so after the 1st of July, and looking at the business to consumer procedures, there is a value limit, the consignment value less than €150. That's because €150 is the limit over which you have to pay duty. Under the €150, there is no customs duty and just VAT. But they've decided to do away with the €22 limit, so every import into the EU from distant sales will be subject to EU VAT. The place of supply, or where VAT will be charged, will be the place of destination, that is the customer's country. But the procedures will mean that there's no more need to register for VAT in each EU country. VAT is charged on purchase. That's different from the scheme at the moment, where import VAT is charged by the authorities. It will be up to the seller to charge VAT on purchase. So just to give an example of that, and take quite a topical subject, we've got the European final coming up on Saturday. So Manchester City will want to sell their shirts to people in France, as they beat Paris in the semi-final. So people in France will be welcoming by buying Manchester City shirts. So Manchester City want to sell their shirts to EU countries. Each shirt is less than €150, even though shirts are going up and up these days. It's less than €150. So they've got a website to do that. So people will log on to the website, order their shirts, and these shirts will be delivered to the country concerned. VAT now, UK VAT will not be charged, but VAT will be charged at the country of destination. So if those shirts are sold to France, French VAT will be due, or French TVA will be due. How is that done? Well, the import one-stop shop is one of the answers. There's a few other simplifications which I'll mention, but the import one-stop shop is the major one. So the firm selling the shirts will register for VAT in one EU country. It can be an EU country of their choice. So in the UK, my experience at the moment is most businesses are going for Ireland, Republic of Ireland, or Malta. And that's because of the no particular language problems. Obviously, you're free to choose whichever country you like. And I think that may well diversify because of another issue, which I'll mention in a few minutes. But at the moment, any EU country of your choice, you register in that country, you register for IOSS, and then you have this IOSS VAT return. So the firm selling Manchester City shirts will report on their IOSS return all the revenues from sales to France or Spain and Germany, wherever those shirts are sold. They'll charge VAT at the country of destination. That's the important point. And that will not have to be shown on an invoice necessarily, because there's no need to issue invoices when it's business to consumer under the VAT regulations. But the EU Commission have said it should be shown on the website and agreed with the customer at the order, so you know which country's VAT you are going to charge. The problem with VAT, and there's always been a problem, and they'll be able to solve it, is of course for each EU country, different VAT rates will apply. So on the Commission website, they publish a list of the current VAT rates in each particular EU member state. One of the downsides to the IOSS is that a company not established in the EU will be required to appoint an intermediary. And this is the point I mentioned earlier, where it may well be diversified from just being a language, getting the best language facility you can to get in the best country you can. Because intermediaries, some countries will make intermediaries have a joint and several liability for the VAT, which means if you as the UK company don't pay the VAT, they can come to the intermediary for payment of the VAT, so a joint responsibility. There are some countries, I think Germany is one, where this shared responsibility will not be in place, so they say. So it may be better to go to Germany because your intermediary is not jointly liable. The point being, of course, that if an intermediary is jointly liable, it'll cost you more in terms of guarantees, indemnities and things to appoint that particular intermediary. So the IOSS one-stop shop that's taken its lead from the MOS system. It will reduce the processes for UK seller companies. There are downsides with the intermediaries, but it'll reduce the processes. No need to register in each particular member state where you've got customers, as would have been the case. One registration in one member state. If goods are sold for more than €150, then normal rules will apply, and those normal rules will be an export from the UK and import into the country concerned, with import VAT being due. Under the IOSS, another advantage of IOSS is that the goods can be cleared because there is no VAT due on import. The goods can be cleared in any member state, doesn't matter. With the normal rules, where the goods cost more than €150, for example, then the goods have to be cleared in that particular member state from where they're going, where the customer belongs. So that is another complexity as well. As another issue, from the 1st of July, the EU Commission, in their wisdom, made electronic interfaces or online marketplaces liable for VAT. Where certainly where the customer doesn't register for, well, the supplier doesn't register for the IOSS, and in fact it's to be mandatory. If you sell through a third-party website, that website will be responsible, marketplace will be responsible for the VAT, in which case you as the supplier do not have to register in that particular country. So again, if you're selling through a third-party electronic interface, then that is another issue for you. All you will do is they'll be called deemed suppliers. It's a VAT fiction. It might be friction, but it's a VAT fiction. The deemed supplier. They're not actually the supplier legally. You, as the UK company supplying the shirts in my example, are the supplier, but the electronic interface or online marketplace will become the deemed supplier for those goods and take a full part in the process. What will happen there is that the supplier will make a deemed supply to the interface or marketplace. That will be without transport, and so therefore it's from the UK. They'll be not subject to any VAT because that takes place outside of the EU. So it'll be outside the scope of VAT supplied by the supplier to the marketplace. There'll then be an on-supply by the marketplace to the customer in whichever country the shirts are being sold to. Online marketplaces, if they're not established in the EU, will have to register themselves for the IOSS and have the one IOSS return. So electronic market interfaces, online marketplaces, I confuse the two and switch between the two. That's mainly because the EU refers to them as electronic interfaces. The UK refers to them as online marketplaces. But they're any portal or website, Amazon is a good example, who facilitate the sale of, in my example, the football shirts. But if you're selling through an online marketplace interface, then the online seller does not have to register in the EU because the interface is responsible for the VAT. And there is a further simplification, if you like, as far as the EU is concerned, and this does not apply at all when we look at the UK rules. But in the EU, if neither the seller nor the online marketplace is registered for VAT, VAT will be payable on imports. In other words, it's kind of a voluntary thing. The IOSS is not mandatory. It is not mandatory at all. You can register in every member state, which may not be a good idea, but you can do it. But it's not mandatory. But if you don't register at all, then if it's as long as the consignment is less than 150 euros, the postal operator, courier, whoever it may be, is responsible for collecting the VAT. Not necessarily a very good idea for customer relationships, because the postal operators and couriers will collect the VAT from customers. You've always got the issue if the customers are not aware, then they may reject the goods anyway. It may cause delays because the delivery will be delayed until the VAT has been paid. So not a good idea necessarily from a customer's point of view. Gives them a little bit of extra hassle. And to compensate the postal operators and couriers for undertaking this scheme, they will be able to collect the VAT but pay it to the authorities monthly. So not straight away. They can keep it, use it as working capital for a few weeks, and then pay it over, which time they got more VAT they've collected. So that's supposed to be how, if you think it is, it depends on your point of view, but that's the kind of bone, if you like, for postal operators and couriers to take part in this scheme, and they will pay the VAT as opposed to anybody registering for VAT. So that is not, the UK is not operating that system within the UK at all, but the EU are, and it's a further simplification for online and distance sales. Moving back to the UK, and the UK goods coming into the UK where they've been ordered online or distance selling. The UK took the opportunity to revamp their rules on the 1st of January 2021. We'd left the EU at that point, so therefore we're free to do what we wanted, or the UK were free to do what it wanted, so it had the wherewithal to put these rules in place from the 1st of January. Just as a little aside and a bit of history, both the EU and the UK were supposed to implement these rules on the 1st of January 2021. The EU decided they weren't ready, and so they delayed until the 1st of July 2021. The UK said, yes, we're ready. We haven't got 27 countries to worry about. We just do what we like within ourselves. They were ready. They implemented on the 1st of January. The EU, there was a strong rumour, would have to delay even further until 31st December or 1st of January 2022. But suddenly, a few weeks ago, we got the nod that everybody was going to be ready, and it will be from the 1st of July 2021. My worry, I think, is that are all the 27 countries ready for it? And will there be some, I'm sure there'll be some teething problems around the 1st of July. But that's goods going out. Goods coming in to the UK from outside the UK. There'll be an exemption for goods valued less than £135, or for consignments valued less than £135. And I will actually stop there as another aside, something I didn't make clear. It is the value of the consignment, both the £150, €150 EU relief and the £135 UK relief. It is the value of the consignment, not the value of the individual goods. So if my company selling Manchester City shirts sold 3 or 4 shirts and the value was £200, then that would be a normal export from the UK, import into the EU, because that would be one consignment of more than €150. So the value in the UK is 135. Under that £135, there is no import VAT. And I think the reason why we have not, or the UK has not invented the postal carriers scheme is because we still refer to it as, well, we refer to it now as no import VAT. The EU don't. They still refer to import VAT. It's just how it's paid, how it's who's going to pay and when it actually gets charged. As far as the UK is concerned, what the UK has said is there is no import VAT. This is going to change, or has changed from the 1st of January 2021 to the overseas seller having to charge UK VAT on the sale. So coming the other way, I am sure that continue my football football theme. I'm sure that Villarreal in Spain want to sell their shirts to Manchester. I'm sure they'll be very pleased to, and Manchester will be very pleased to have them. So let's think of it the other way. So the Spanish seller is selling the products into the UK. Each one shirt is ordered, less than £135. The overseas seller now has to charge UK VAT on the sale, and to do that, they have to be VAT registered, and that is the big change. So it's not import VAT anymore; it is VAT on the sale, where the value is less than £135. So VAT registration is required by the supplier, who have to charge VAT on their, show the price on the website, charge VAT, register, and go through the whole of the hoops that Anil was talking about earlier, having to register and provide VAT returns and submit VAT returns quarterly to HMRC, etc., etc. There's no one-stop shop system. You have to register for that in the UK, and you've charged VAT on the sale. Except if you are selling through an online marketplace, such as Amazon, then the OMP accounts for VAT if the seller's not VAT registered. So the seller might be VAT registered if they maybe want to bring in consignments of more than £135. Normal export VAT, import VAT into the UK, they may want to register to pay that import VAT and reclaim it again. So there could be a registration system and an online system as well. But for consignments valued less than £135 sold through an online marketplace, the online marketplace we're responsible for accounting for VAT on those goods. So the OMP accounts for VAT, so there's not VAT registered. So in other words, there can be a deemed supply from the seller to the marketplace outside the scope of VAT, then the marketplace would charge VAT and account for that VAT to HMRC on that deemed supply of the shirts. Before I move on, that's it in the UK as far as low value goods are concerned. There is no remit to account for import VAT or collect import VAT by postal carriers, etc. It is simply VAT has to be charged by the seller when the goods are sold, either by the seller registering for VAT or through the marketplace if the seller doesn't register for VAT. And if the marketplace, if you're selling all the goods through your marketplace, less than £135, there is no requirement to register for VAT if you're a Spanish shirt seller, should we say. Which brings me to the OMPs, online marketplaces. New responsibilities for goods in the UK at the point of sale, because VAT has to be accounted for the point of sale. Also, where overseas sellers hold stock in the UK. This is something akin to what the EU are going to be doing. If an overseas seller holds stock in the UK, then they're making the supplies in the UK. And a lot of these have slipped through the net and has not been a particularly level playing field. Where an overseas seller holds stock in the UK, they are responsible for getting that stock into the UK, so they will be charged import VAT when the stock comes into a warehouse in London, Coventry, wherever it might be. But if they then sell through an online marketplace, there is a deemed supply to the marketplace. They have to register for that. There is no getting away from that one. If you hold stock in the UK, the place of supply is the UK. You have to register for VAT in the UK, even though you haven't got a place of establishment or business in the UK, or you've got as a stock of goods in a warehouse. You're still liable to register for VAT in the UK. And as I say, that has kind of slipped through the net, particularly in recent years. So to get it back on track, you have to register. You'll be charged import VAT. You can claim that import VAT back on your UK VAT return. You then make, if you're selling through a marketplace, you then make a deemed supply to the marketplace, which is not outside of the scope because the goods are in the UK, but that deemed supply is 0 rated. So there's no need to charge VAT on it. It's deemed to be a 0 rated deemed supply to the marketplace. Then the marketplace will account for the VAT on the sale of those goods in the UK. So again, where the goods are held in stock in the UK, there's a registration responsibility. The OMP is liable to account for that. And the last bullet point on the slide there is I thought I'd mention, if I mentioned it in passing, but if goods are held in stock in an EU country by an overseas seller, so a UK business holds stock in Germany, for instance, or Italy, then they're liable to register for VAT in Germany or Italy, and they would then use the OSS scheme, the one-stop shop scheme. It's not import anymore, that's already been dealt with. Because they're in the EU, they can use the one-stop shop scheme to account for VAT on supplies to every single member state in which they make supplies to, which they've got customers to. Again, this is business to consumer, not business to business. Very briefly, business to business, normal rules apply. It's export from the UK, import into the EU, wherever it might be, or if the other way around, it's an import into the UK, to the UK business. The UK business accounts for import VAT. Just going back briefly though to online selling, to give you an example of the UK viewpoint here since the 1st of January 2021. I'll move away from football shirts. I'll go on to more mundane printers ink or ink for computers. So ink cartridges. If you buy ink cartridges from a seller in France last year, the seller in France would charge you French TVA unless the distance selling rules had been broken. The distance selling rules being the rules that Anil talked about earlier on. From the 1st of January, if you buy online ink cartridges from France, the French seller will have to charge you UK VAT, and they have to register that to do that. If you buy it through a marketplace, of course, then the French seller may not have to register for VAT in the UK, but the marketplace will have to charge you UK VAT because you're in the UK. So that's the system that'll work. The reason I've gone into that a little bit more detail is just want to explain a little bit about business to business, because and that's why I've used ink cartridges rather than football shirts. If you, as a UK business, buy your ink cartridges from a supplier in France online, as I say, the French supplier has to charge UK VAT, except because you're a UK business, if you give your VAT registration number to the French seller, it'll be rather like the old days. The French seller will not charge you any VAT at all, and you will account for the UK VAT by means of the reverse charge. There's no import VAT because it's under £135, but you will account for UK VAT by means of reverse charge, which means count for VAT as output tax payable to HMRC, and because it's for your business, claiming back on the same VAT return your self-generated VAT charge. So little complication there, which I thought was worth mentioning, because if you don't do that, and if you simply buy from online sellers, don't give them your UK VAT number. Yes, they will charge you UK VAT, but I don't have to invoice for it. So you have nothing there to prove any input tax recovery from HMRC, so you could lose out by paying more than you need to. I know we're talking about an ink cartridge, but it could be a bit more expensive than that. That's when the value is less than, of the consignment, is less than £135. Okay, Neil, I think you're going back to explain the bit in the middle.
Do we have time, Chris, for
we're a little bit short of time.
Okay, we can go for questions and answers directly.
Yeah, I mean,
If you just want me, all this is actually, Neil's going to speak to this, and I don't want to steal on Neil's thunder, but this is the bit in the middle at the moment. You can't use any simplifications in the EU. You can't register IOSS until 1st of July. You can't appoint whoever do it for you. So this slide here is shipping products now to EU private customers in the EU. Then it's a case of how you handle import VAT, which will be easier, as I said, after the 1st of July, but it's a case of making sure that the customer is aware they may have to handle import VAT. There have been a number of cases, and still are, of goods been returned because it's been a complete surprise to the purchaser. They've got to suddenly pay import VAT. But, sorry, I don't want to steal Neil's thunder, but just to briefly mention that.
Yeah, I mean, a couple of things, and thank you, Tim. I mean, again, very detailed and very comprehensive. I mean, for somebody that is not familiar with this, it's all rather overwhelming.
I'm sure it is. Yes, I'm sure it is.
Respects.
It was called gobbledygook once, but I'm sorry, don't shoot the messenger.
Well, no, exactly, and a couple of things sort of come to my mind, and I mean, the main one is all this is Turkey specific. I mean, you talk about the EU, but this applies to Turkey as well.
It will apply, well, as far as Turkey is concerned, I'm thinking of Turkish businesses in the UK having to send goods all over the world. Within the EU, there is a system. Outside the EU, then it's still an export-import situation. As far as goods going from the UK to Turkey are concerned, then those goods will be zero rated, import into Turkey. If goods come from Turkey into the UK, then it will be export from Turkey, import into the UK. And on a business-to-business angle on that, what HMRC have done, they've reintroduced something called postponed accounting. So if you are a business-to-business transaction, so goods coming from Turkey into your company in the UK, you'll be charged import VAT by HMRC. Up till a Brexit day, that VAT had to be paid to HMRC before the goods were cleared, and you'll recover that VAT on your VAT return at a later date. From the 1st of January 2021, it's optional for the moment, for the next year, but till the end of the year, but it's optional. But you can use something called postponed accounting, whereby you simply declare the VAT due to be paid to HMRC in your VAT return, pay it on your VAT return, and also reclaim it on the same VAT return. So great from a cash flow point of view. That system is optional until the 1st of January 2022. From that date, it will become the system, compulsory system, where everything will be done on postponed accounting. And that's a business-to-business transaction. Business to private, then it's a case of having to, if you're supplying private individuals in the UK from Turkey, it's a case of making sure that they're aware of what's going to happen, that you either register for VAT, your Turkish company for VAT in the UK, claim back the import VAT you'll be charged, postponed accounting for that, then charge that onwards. So yeah, the system's different, business to business, business to consumer. As far as Turkey concerned, business to business, not too much difference in the mechanics of it, apart from postponed accounting being introduced.
Yeah, well, I mean, obviously, not just our guests on the webinar who are Turkish and Turkish companies looking at how they navigate their way through this VAT forest of regulation.
Well, sorry, Chris. I mean, just taking an example of Turkey to the EU, for example, after the 1st of July, for instance, they will be in exactly the same position as a UK company into the EU. Will have to navigate the one-stop shop system, whether they keep goods in the EU, what the value of those goods are, because €150 applies to everything by consignment to every single country in the world. So Turkey would have exactly the same problems and issues with goods coming into the EU, as the UK will have from the 1st of July. And I think there might be teething problems with it. But yeah, you have to look at the value of the goods, who they're going to be supplied to, whether you're going to
Tim,
on the one-stop shop. Sorry.
I mean, Turkey has a customs union agreement with the EU. I mean, they're considered part of the EU. So, I mean, why would Turkish companies be subject to the same VAT regulations that UK have?
Unfortunately, in that sphere, the agreement, unless they've got an agreement, I don't think they have, whereby, I mean, Norway is exactly the same. They can have a very close agreement with the EU, but it still means that they're not EU goods. You're not an EU supplier, shall we say, and goods coming into the EU will still be imports into the EU, however close your relationship. Yes, you may get duty preferences and no duty, but VAT is totally different, and VAT has to be charged on imports into the EU by Turkish companies as well as UK companies, Norwegian companies, Swiss companies, whatever. If you're not a member state of the EU, then goods coming into the EU, they will be imports and have to be dealt with accordingly.
Those custom agreements are more focused on custom duties, Chris. It's not covering the VAT duties, actually. So someone shipping from Turkey to EU still subjects to import VAT in EU.
Yeah, so and that applies to UK as well now.
Yes, it does.
I think it's important to clarify these, because I'm sure a few people are asking the same question.
I mean, you know, if you're an e-commerce company and if you are selling your goods online, this means that your customers can be anywhere. It can be EU customer individual, it can be America, rest of the world, anywhere. So for my recommend for all e-commerce business people should be, they should be really careful understanding those VAT rules for each region or maybe for each country, because they are selling online and they receive their payments by order online. So if they don't know those VAT applications in different countries, they will probably collect less money from their customers. They can face this problem. So on those online portals, they should set in the software different VAT rates for each country where the goods are ordered from. So if it's a Dutch individual ordering from your system should be familiar with the Dutch VAT rate and should put the correct amount to make the customer pay for you. This is crucial, I think. This is why all those complexity is for, so that the e-commerce businesses get the correct amount from their customers and do not face any surprise later.
Yeah, I mean, it's critical that you do understand this. I don't know whether there's, SRM are producing a what shall I say, a simple guide, a publication that actually, gives examples and demonstrates all these VA2 rules and regulations. But I mean,
I've certainly got some examples. I haven't got time to show them, but yeah, maybe that could be done. So I think
a little booklet that gives us a simple guide through it. But I mean, for SMEs, I mean, this is obviously absolutely relevant, and for also bigger companies as well. I mean, as well as I do, Adil, and Mehmet can also come into this. I mean, a lot of the trade between Turkey and the UK, a lot of it is big business, automotive, and other food products and engineering products and re-engineered products, white goods. So I mean, Beko and Arçelik, who are shipping to UK, not just from Turkey, but also from Romania, where they have a big factory. You know, on automotive transit, for transit vans, you know, being shipped to UK as well. So, you know, there's some big items there. I'm sure they're up to date with the VAT regulations, but if they're not, I mean, we can have to recommend them to you to give them a bit more clarity. But
yeah, okay. So far as the duty is concerned, yes, you've then got the origin. You know, okay, you've got the trade agreement, but it only applies to the goods originating in Turkey, just as the EU is goods originating in the EU, and to the origin is not always that clear or established in the origin. It might just be natural product, which is fine. If it's not, you've got to go through those complex valuation rules to work out whether you've got it's going to be wholly originated in Turkey or classified as Turkish goods or not, the same as UK goods, the same as EU goods. And you know, is it going to be a value added to it? Is there a change of trade classification to it? Is there a process? You know, there are a lot of goods being held up now because of you know, the origin rules and people not having the right certificates of origin. There's a lot of duty being paid, I think, because the origin certificates are either not valid or people have not because it's fairly low value. I'm sure because you've been talking about, yes, it would be, but in low value goods, it's not worth establishing the origin. So it's simpler just to pay the duty unless there's a preference. And yes, Turkey and the EU have got their agreement. So as long as they're Turkish goods, and the UK, Turkey have got the agreement. As long as they're Turkish origin goods, UK origin goods, then fine. But it's establishing that which is causing a lot of problems. And I don't want to be too despondent, but what I'm hearing on the grapevine is that a lot of this has gone through with simplified declarations and goods being let through. I think they may well have in the UK, we may have a logjam at the end of this year when those supplementary declarations have to be finalised, and the finalisation of them could take some time and could jam up the system. But I do not want to end up depressive notes, so can I just I'll gloss over that one. But duty, yes, is another issue, and certainly what you've been talking about, Chris. Yes, it's duty is important, but for VAT at the rate in force, at the rate of the rate in force in the customer's country is going to be the one that is chargeable, or import VAT is going to be charged on the rate in force in that EU country, no matter where those countries are, no matter what agreements they've got. Unless they're a member state of the EU, there is no such thing as having free VAT trade. It just doesn't exist.
Well, thanks for that, Tim. And country of origin is, as you say, another grey area at the moment that does need a good deal of clarification. It's something that, you know, we're working on as well, and you know, for Turkey, because Turkey, in terms of imports from UK, are very strict on country of origin. So, you know, it's something that does need to be clarified, and it's probably a webinar we need to have where we can see through the fog. But it's you know, all these aspects are critical if we want to, you know, develop and build our current trade with Turkey, and you know, that's the intention. You know, we've got over 19 billion pounds worth of bilateral trade with Turkey, so it's a, you know, it's a priority market, it's a big market, and you know, we don't want this bureaucracy to get in the way.
That's my worry. That's my big worry. Yeah.
So you know, it's something that we have to bring clarity to as much as we can with the information that we have, and I'm sure Mehmet's, you know, probably closer to it than I am, along with our DIT colleagues. But yeah, it's something that we just have to, you know, keep a watching brief on to make sure that, you know, nothing slips between sort of two stools, if you like. And as I say, now we have this free trade agreement with Turkey, which we want to build on and enhance and strengthen. Then all these other areas, these other component parts relating to, you know, tariffs, rules of origin, and VAT, you know, have to be very clear so that companies can actually operate, you know, with you know, a clear understanding of what they're going to be faced with. So yeah. So I mean, I think we'll have to draw it to an end. Yeah, I would ask, anybody participating, if they do have further questions that require further information, then please go onto our email at BCCT, and we'll pass on those questions onto either Anil or Tim or Mehmet, and they'll be happy to answer those for you. But
Sure.
as I say, I'd just like to thank our speakers for their advice and guidance. I would have hated to have gone through that myself with that sort of detail. I mean, you need experience and knowledge and experience to make it sound understandable. And I congratulate you on getting that message across, because it's it is quite frightening and particularly SMEs who don't have the resources or the understanding of how to get to the bottom of this. And I'm sure SRM can provide the right sort of guidance when it comes to understanding things. And to Mehmet, who as usual gives us the opportunity in UK that it offers great opportunities for investment, and we want to build on that as well. But as I say, this is part of it, so we need to be aware of it. So thank you to our speakers today. They've done an amazing job in getting this information across to us, and we'll be welcoming them back quite soon, because we've set the ball rolling, and we need to keep it rolling and build on the knowledge that you've already shared. So thanks again to everybody, and take care, and we'll be in touch again later. Thank you.
Thank you.
All. Thank you.
Thank you, everybody.